Welcome to our discussion about PLTR, Palantir Technologies, stock. Today, we're going to uncover why smart investors prefer to hang on to their PLTR investments instead of selling too soon. If you want to make wise investment choices, stay with us. And don't forget to like, subscribe, and turn on notifications for more helpful insights. Let's dive into the reasons behind this strategic decision. 1. Palantir's positive strides. Palantir Technologies has been making remarkable progress in recent times. This means the company has been actively taking significant steps to enhance its financial performance and strengthen its position in the market. Such positive strides may encompass a range of achievements, including a notable increase in revenue, efficient cost management, expansion of its customer base, or the successful execution of strategic initiatives. When investors observe a company consistently making such positive moves, it typically signals that the company is on a trajectory towards success. Essentially, it indicates that Palantir is moving in the right direction, which can significantly bolster its appeal to potential investors who seek stability and growth in their investments. 2. Promising future prospects. When assessing Palantir's future prospects from an external standpoint, it becomes evident that the company holds substantial promise. Palantir has demonstrated its ability to effectively execute its growth strategies, resulting in profitability. This profitability serves as a positive indicator of the sustainability and effectiveness of Palantir's business model. When investors perceive a company as having promising prospects, it suggests that the company has ample room for expansion and long-term success. This optimism regarding Palantir's future can drive investor confidence and increase the attractiveness of the company's stock. 3. Q2 2023 Earnings Announcement. Recently, Palantir divulged its financial results for the second quarter of 2023. These results were found to be largely in line with market expectations, signifying that they closely match the predictions of investors and analysts. However, what sets this quarter apart is the context of prior performances. In previous quarters, Palantir consistently outperformed these expectations, meaning they exceeded what people had anticipated in terms of their financial results. Surprisingly, this time, the market's response to the news was somewhat subdued, indicating that investors didn't react as strongly to the results as they had done previously. This subdued reaction suggests that the market's expectations have potentially adjusted, or that investors are closely monitoring Palantir's performance for signs of sustained growth. 4. Mixed Q2 2023 Financial Performance. In the second quarter of 2023, Palantir reported a total revenue of $533 million, marking a 13% increase when compared to the same period in the previous year. On the surface, this revenue growth appears to be a positive sign, indicating that the company is earning more money. However, it's crucial to delve deeper into the financials. Despite the increase in revenue, the earnings per share, EPS, remained relatively low at just 1 cent. This signifies that while Palantir succeeded in boosting its overall revenue, it didn't necessarily translate into significantly higher profits for each share of the company's stock. In essence, the mixed financial performance implies that the interplay between revenue growth and profitability requires careful consideration and assessment to grasp the full financial health of the company. 5. Concerns about revenue growth. Revenue growth serves as a vital metric for companies, as it reflects the rate at which they are expanding their income. In Palantir's case, their revenue growth rate fell short of their stated goal, which aimed to achieve an annual growth rate of approximately 30%. This goal signifies the pace at which they aspired to increase their revenue from year to year. Falling short of this ambitious target raises valid concerns, as it suggests that Palantir may be facing challenges or external factors that are impeding their ability to realize their revenue growth ambitions. In simpler terms, they wanted to grow faster, but the reality didn't quite meet their own expectations, prompting a closer examination of the factors at play. Before we dive deeper into these reasons, here's a quick reminder. If you're finding this information helpful so far, please take a moment to like this video and subscribe to our channel for more insightful content. Done? Okay, let's get back to our topic. 6. Forward-looking perspective. Palantir is looking ahead and has set ambitious revenue targets. They aim to generate $2.2 billion in annual revenues in 2023. To support this projection, they achieved impressive billings of $603 million in Q2 2023, which represents a 52% year-over-year growth rate. This suggests that Palantir is doing well in terms of billing its customers for its services. Such strong billing performance indicates the potential for increased revenue in the coming quarters. In simple terms, the company is setting high revenue goals and has shown that they're on track to achieve them. 7. Strategic move with AI-focused platform. Palantir has taken a strategic step by launching AIP, AI-focused platform, alongside their existing offerings like Foundry and Apollo. This move indicates that Palantir is optimistic about the growth of artificial intelligence, AI, and its potential impact. AI is a technology that involves computers doing tasks that typically require human intelligence, like learning from data and making predictions. By investing in AI-focused platforms, Palantir is positioning itself to benefit from the growing demand for AI-related solutions. However, the financial impact of these AI platforms is still uncertain until Palantir provides specific revenue figures related to these ventures. 8. Emphasis on profitability and financial strength. Palantir has placed a strong emphasis on profitability, which means they are focused on making more money than they spend. They expect to report a consistent positive GAAP net income throughout the year, which is a positive sign for investors. Additionally, Palantir is in a robust financial position, holding over $3 billion in cash and having no debt as of June. This financial strength allowed the company to announce a share buyback program worth $1 billion, which is the first such initiative since its DPO, direct public offering, in 2020. Share buybacks are when a company buys back its own shares from the market, which can boost the company's stock price. With ample cash resources and the ability to generate healthy cash flows, Palantir is in a good position to consider further share buybacks in the future, which could benefit investors. 9. Deceleration in growth. Amid economic conditions, while Palantir has experienced a recent slowdown in its growth momentum, this slowdown appears to be more a result of challenging economic conditions rather than any fundamental issues within the company. The company continues to expand its customer base, which means they are attracting more clients. Additionally, they have improved profitability, indicating that their strategies are effective. It's important to understand that economic conditions can affect a company's growth, as customers may prioritize cost-cutting and efficiency enhancements over new spending on data analysis solutions. So, Palantir's growth slowdown can be partly attributed to the economic environment. 10. Valuation metrics and trading multiple. Palantir's valuation has shifted from being based on speculation to being rooted in earnings-based analysis. This means that investors are increasingly looking at the company's earnings, profits, as a key factor in determining its value. However, it's important to note that while Palantir's valuation has shifted, its current trading multiple stands at over 60 times its forward earnings. This high multiple suggests that investors are willing to pay a premium for Palantir's stock relative to its expected earnings. The most pertinent valuation metric at present is the enterprise value to revenue ratio, which indicates that Palantir is currently trading at approximately 12 times its enterprise value over its revenue. This valuation metric is slightly above its historical average over recent years, suggesting that the stock may be considered relatively expensive by some investors. And there you have it, the reasons why holding on to Palantir stock might be the way to go. But now, we want to hear from you. Do you agree with the decision to hold Palantir for the long term? Share your thoughts in the comments below. And if you found this discussion valuable, please show your support by liking and subscribing. Your insights are crucial in our financial journey together.